morning to all of you. So this wake-up call is about adapting to climate change, and specifically adapting portfolios to climate change. I'm going to tell you why we think it's a good idea to consider doing this, and then John will tell you how you can do this. So we have 15 minutes. Here we go. So this is not working. This is great. We're missing part of the screen. OK, this is going to make life interesting. First reason why you want to consider adapting your portfolio to climate change is for real. And it's worth reiterating that now that the first economy in the world have elected a president who thinks climate change is a joke invented by the Chinese in order to make US manufacturing non-competitive. So actually, the North Pole, just a month ago, was 20 degrees warmer than it normally is this time of the year. And 2016 is on track to be the warmest year on record ever. So that's the physical dimension of climate change. And it matters to far many more companies than you might think. It matters if you're an insurance company, but it matters if you're any kind of company that has a global supply chain with parts coming from areas of the world that will be affected by climate change. The second dimension of this change is technology. Again, let's go back to Donald Trump. In 2012, he said wind turbines are not only killing millions of birds, they're killing the finances and environment of many countries. And earlier this year, again, windmills don't work without subsidies. Well, guess what? In 2016, unsubsidized wind is the cheapest source of power. And likewise, solar panels in many parts of the world are now cheaper source of energy than many from non-renewable sources. And just to give you a sense, this technological change is accelerating. The production of electric vehicles forecast to jump from 500,000 last year to 4 million within 10 years. And as we will hear at lunch, you can now fly around the world on a plane powered by solar panels. So this is all changing very fast. That's the technology dimension. Third dimension of the change linked to climate that is very relevant for investors is regulation. As you know, here in Paris, just over a year ago, more than 100 countries committed to very ambitious goals to reduce carbon emissions. And this agenda is going to continue to impact everyday life for companies, for citizens. We already have regulation on emissions. There's going to be more regulations on energy efficiency. And increasingly, the focus of this regulatory agenda goes on companies having to disclose more about their exposures to climate risk and their strategies to deal with it. And increasingly, the focus is moving on to not just industry, but also financial industry, and being more transparent about the climate risks embedded in portfolios. So these are three important drivers. OK, so what can you do about it? Second reason, climate change, if you don't pay attention, can lose you money. You don't want that. If you had invested in US coal at the start of January 14, by now you would be down 80% on your portfolio. OK, if you had invested at the peak, 85%, and during a time in which the S&P 500 was up 10%. Clearly a bad investment decision. You want to minimize your exposure to this sort of risk, and the good news, and John will touch on that, is you can do this very cheaply. Buy insurance against this kind of risk. There are solutions to do this very cheaply. OK, reason number 3 for paying attention to climate change in your portfolio is you can make money. So here we did a little experiment. We take the Russell 3000 index in the US. These are small cap companies. At the top of the screen, the index emissions of the entire portfolio. Then what we did is we focused on companies that have most improved their energy efficiency over the last 3 years. And that's the purple line in the middle. You see these companies reduced significantly their emissions compared to the overall index. But what's great is look at their performance, their stock performance. They outperform the broad market by 7% at the same time. So by focusing on those companies that are the most helpful from a climate change standpoint, you can improve your financial returns. Okay, and finally, last reason why you want to pay attention to these developments is social awareness is rising. This is just a sample of companies that have had to make very significant strategic shifts in response to pressure from their customers to take better account of the impact of their activities on climate change. And as I was saying, increasingly the focus and the pressure is going to shift on financial intermediaries, asset managers, asset owners, and anticipating this pressure, a number of them have already voluntarily committed to managing their assets in ways that are aligned with the goals of the climate transition. So here are the 4 reasons why you want to think about adapting your portfolio to climate change. And I'll now hand it over to John to tell you how you can do this.
Great. Thank you, Isabelle. And thank you all for having us here today. It's clear that at BlackRock, we recognize climate change is real and that it matters. We also recognize that there are a number of ways investors can take action today to both mitigate climate-related risks, but increasingly to identify and exploit opportunities associated with the transition to a low-carbon economy. And let's be clear, as Isabelle mentioned, more changes are coming. Here in France, for example, with the passage of Article 173, the new energy transition law, many of you in this room will be required by law to disclose for the first time your portfolio's exposures to certain climate risk factors, broader ESG issues, and this could take effect as soon as June 2017. So amid the increased regulatory pressure, the changing social awareness, the technological disruptions, we believe that climate-aware investing is no longer a choice, but an essential component to smarter long-term investing. We also recognize there's no one-size-fits-all approach to addressing these issues across your portfolio. So at BlackRock, we've developed a range of strategies to enable investors today to begin incrementally integrating climate-aware strategies across their entire asset base. And this ranges from divestment, so excluding certain sectors, carbon-intensive industries, fossil fuels, for example, increasingly focused on low-carbon strategies, as Isabelle mentioned, optimizing for lower carbon exposure while maintaining a benchmark-aware strategy and a low-cost approach, and also investing much more thematically in terms of alternative strategies, looking at new energy technologies, clean technology, large-scale wind and solar projects, for example. And the options you choose will really depend on your own motivations, your objectives, your asset allocation, your current exposures. And what we found is to best understand what strategy is best for your goals, it really starts with better understanding and really to know what you own. So here we look at standard kind of asset allocation, standard portfolio, and the way that we're helping clients really get a better view in terms of their current holdings is by integrating ESG data, including carbon emissions data, carbon financing data, into our risk analytics portfolio management system called Aladdin. And this platform enables us to provide an ESG snapshot, carbon footprints of our clients' portfolios relative to their benchmark as a simple way to help them better understand their current exposures. So if we take the standard example, just a standard portfolio, and apply a carbon footprint, we begin to understand on a relative basis what the current exposures look like. So in this case, we see that this portfolio is generating about 221 metric tons of CO2 emissions per $1 million of revenue. And this is the equivalent of nearly 25,000 gallons of gasoline on an annual basis. And again, going a layer deeper, we can see that 76% of this portfolio's carbon emissions are actually generated through their equity allocations. So, and if we were to go even a layer deeper, which we often do, is really looking at which sectors, which companies, which geographies are disproportionately driving that carbon exposure, and if using that information essentially to decide if you want to take action to reduce your carbon exposure, you now have a lot more information to tactically do that across your portfolio. And to help bring this to life, and really, I think one key observation through the research that we've conducted at BlackRock is we found that through small tweaks, you can have a big impact in your portfolio. So taking the low carbon optimization approach as an example, Again, here, this is a broad-based equity strategy, looking at essentially overweighting climate-friendly companies, underweighting climate offenders, while maintaining the goal of maintaining as low tracking error to the benchmark as possible. And what we found using MSCI World, for example, is that you can actually reduce your carbon exposure by up to 70% within a 30 basis point tracking error. And this is compelling because it's enabling more investors to maintain their standard risk-return profile while measurably reducing their carbon exposure in real ways. It also enables more investors to participate in the potential upside as more companies themselves, some of the largest climate offenders today, are also adapting, innovating, and can very well become drivers of new technology, renewables in the future. So there's a potential upside by using optimization versus removing exposures from your portfolio. But the question is really, what are you doing? The clock is ticking. For many of you, the Article 173 requirements will take effect in about 7 months. So you literally have a ticking clock, and the question is, what will you do? I think across the asset management industry, we're building our commitment. We're committed to solving these large-scale issues through your investment strategies. We're enhancing our own capabilities, but much of this requires action from you as well. So what are you doing today to take action?
Yeah.